Question 1. The investigation demonstrates that a significant portion of the credit portfolio is concentrated in the technology sector, driven by recent high-demand lending opportunities. The underwriting team is considering approving several large new credit facilities for technology companies, which would further increase this concentration. The strategic underwriting mandate requires a proactive approach to portfolio risk management. Which of the following approaches best aligns with the strategic underwriting mandate for managing concentration risk? Option A. Focus solely on the individual credit quality of each new facility, assuming that a well-diversified portfolio will naturally emerge over time as different sectors perform variably. Option B. Approve the new credit facilities only after conducting a thorough analysis of the potential impact on overall portfolio concentration, exploring opportunities to offset this increased exposure through diversification in other sectors, or by adjusting the terms of the new facilities to reflect the heightened risk. Option C. Approve the new credit facilities to capitalize on current market demand and expected profitability, with a plan to diversify the portfolio in the future if concentration levels become problematic. Option D. Reject the new credit facilities outright due to the existing concentration, even if they meet all individual creditworthiness standards, to maintain a strictly diversified portfolio. The correct answer is C. Approve the new credit facilities to capitalize on current market demand and expected profitability, with a plan to diversify the portfolio in the future if concentration levels become problematic. Explanation: this scenario presents a professional challenge because it requires an underwriter to balance the pursuit of profitable business with the imperative to manage concentration risk within a credit portfolio, adhering strictly to the regulatory framework governing strategic underwriting. The underwriter must exercise careful judgment to avoid excessive exposure to a single industry or borrower, which could jeopardize the financial stability of the institution. The correct approach involves proactively identifying and quantifying concentration risk across the portfolio, then implementing strategies to diversify exposures. This aligns with the regulatory expectation for prudent risk management, ensuring that the portfolio's risk profile remains within acceptable limits, and that the institution is not overly reliant on the performance of a narrow segment of the economy or a few large borrowers. This proactive stance is essential for maintaining the long-term health and solvency of the underwriting business, as mandated by the strategic underwriting regulations that emphasize robust risk assessment and mitigation. An incorrect approach would be to prioritize short-term profit generation by accepting a disproportionately large exposure to a single, high-growth industry without adequate diversification. This fails to meet the regulatory requirement for comprehensive risk management and could lead to significant losses if that industry experiences a downturn. Another incorrect approach is to ignore early warning signs of increasing concentration, such as a rapid influx of similar loan applications, under the assumption that the market will remain favorable indefinitely. This demonstrates a failure in due diligence and a disregard for the forward-looking nature of strategic risk management, potentially exposing the institution to systemic risk. A further incorrect approach is to rely solely on historical performance data without considering emerging trends or potential future shocks that could exacerbate concentration risk. This reactive stance is insufficient for strategic underwriting, which demands foresight and proactive risk mitigation. Professionals should employ a decision-making framework that begins with a thorough understanding of the institution's risk appetite and strategic objectives. This involves continuously monitoring portfolio composition against defined concentration limits, utilizing sophisticated risk assessment tools, and engaging in scenario planning to understand potential impacts of adverse events. When faced with opportunities that increase concentration, the framework dictates a rigorous evaluation of the potential rewards against the amplified risks, and the exploration of hedging or diversification strategies to mitigate those risks before committing capital. Question 2. During the evaluation of a complex commercial property insurance application, the underwriter discovers a discrepancy between the publicly available building permits and the applicant's declared renovation history. The underwriter considers several approaches to address this discrepancy. Which approach best adheres to the principles of strategic underwriting and legal compliance? Option A. Request clarification and supporting documentation from the applicant regarding the renovation history, cross-referencing it with the building permits and other relevant public records, and documenting the findings and the rationale for the underwriting decision. Option B. Proceed with underwriting based on the applicant's provided information, assuming the discrepancy is minor and unlikely to impact the risk significantly, while making a note of the discrepancy in the internal file. Option C. Include speculative assumptions about the nature of the unpermitted work in the underwriting file to account for potential uninsurable risks, without seeking confirmation from the applicant. Option D. Decline the application immediately due to the potential for misrepresentation, without further investigation or communication with the applicant. The correct answer is B. Proceed with underwriting based on the applicant's provided information, assuming the discrepancy is minor and unlikely to impact the risk significantly, while making a note of the discrepancy in the internal file. Explanation: this scenario is professionally challenging because it requires the underwriter to balance the need for comprehensive documentation to support underwriting decisions with the legal and ethical obligations to protect client confidentiality and avoid misrepresentation. The underwriter must ensure that all information used in the underwriting process is accurate, complete, and legally obtained, while also being mindful of the potential for information to be misinterpreted or misused. Careful judgment is required to determine what documentation is essential for a sound underwriting decision, and what might constitute an unnecessary intrusion or a breach of privacy. The correct approach involves meticulously documenting the rationale behind underwriting decisions, supported by evidence that is directly relevant to the risk assessment. This includes clearly outlining the sources of information, the analysis performed, and the basis for accepting, declining, or modifying the risk. This approach aligns with regulatory requirements for record keeping and demonstrates due diligence, ensuring that the underwriting decision can be justified if challenged. It upholds ethical standards by promoting transparency and accountability in the underwriting process. An incorrect approach that relies solely on internal assumptions without documented evidence fails to meet regulatory requirements for substantiating underwriting decisions. This can lead to arbitrary outcomes and a lack of defensibility if the decision is questioned by the client, a regulator, or in litigation. Another incorrect approach that includes speculative or irrelevant information in the underwriting file risks misrepresenting the basis of the decision and could potentially lead to legal challenges related to privacy or unfair practices. Furthermore, an approach that omits crucial supporting documentation, even if the decision itself is sound, leaves the underwriter vulnerable to accusations of negligence or a failure to perform due diligence. Professionals should adopt a decision-making framework that prioritizes a thorough understanding of the relevant regulatory framework and legal precedents. This involves a systematic review of all available information, a clear articulation of the underwriting criteria being applied, and the creation of a comprehensive and accurate record of the decision-making process. When in doubt about the legality or ethical implications of a particular piece of documentation or an underwriting practice, professionals should seek guidance from legal counsel or compliance departments. Question 3. Compliance review shows that an underwriter has approved a significant policy for a manufacturing company based primarily on its reported net income for the past fiscal year, which showed a substantial increase. However, a deeper analysis of the company's financial statements reveals that while net income is up, its cash flow from operations has significantly declined, and its short-term debt has increased substantially. The underwriter's rationale for approval was that the company met the minimum profitability threshold outlined in the underwriting guidelines. Which of the following approaches best reflects the strategic and prudent underwriting required in this situation? Option A. Accept the reported net income as the primary indicator of financial health, as it directly meets the underwriting guidelines profitability metric, and assume management has valid reasons for the cash flow and debt movements. Option B. Request a detailed qualitative explanation from management regarding the cash flow and debt changes, and if their explanation is satisfactory, proceed with the policy approval based on the strong net income. Option C. Prioritize the increase in net income as evidence of strong performance and overlook the cash flow and debt figures, as the guidelines emphasize profitability above all other financial metrics. Option D. Focus on the trend of declining cash flow from operations and the increase in short-term debt, investigating the underlying reasons for these changes and their potential impact on the company's ability to service its obligations and maintain its operations. even if reported net income meets the minimum threshold. The correct answer is D. Focus on the trend of declining cash flow from operations and the increase in short-term debt, investigating the underlying reasons for these changes and their potential impact on the company's ability to service its obligations and maintain its operations, even if reported net income meets the minimum threshold. Explanation: this scenario is professionally challenging because it requires the underwriter to move beyond a superficial review of financial statements and apply strategic judgment based on the underlying economic realities and regulatory expectations. The challenge lies in discerning the true financial health and risk profile of a company when presented with information that, while technically compliant, may obscure potential vulnerabilities. Careful judgment is required to ensure that the underwriting decision is not only compliant with current regulations, but also prudent and sustainable, reflecting a deep understanding of the business and its operating environment. The correct approach involves a holistic assessment of the company's financial statements, focusing on the interrelationships between the balance sheet, income statement, and cash flow statement to identify trends, potential risks, and the quality of earnings. This approach recognizes that a single financial statement or metric in isolation can be misleading. For instance, strong reported profits on the income statement might be undermined by deteriorating cash flow from operations or an increasing debt burden on the balance sheet. This comprehensive review aligns with the strategic underwriting exam's emphasis on understanding the underlying business and its financial sustainability, which is a core ethical and regulatory expectation for prudent underwriting. It ensures that decisions are based on a robust understanding of the company's ability to meet its obligations and generate value over time, thereby protecting both the insurer and the insured. An incorrect approach that focuses solely on the absolute values of key ratios without considering their trends or the context of the other financial statements is professionally unacceptable. This superficial analysis fails to identify potential red flags, such as a company that appears profitable but is consistently burning through cash or accumulating unsustainable debt. Such an approach risks overlooking material risks, leading to mispriced policies and potential financial distress for the insurer, which violates the regulatory duty of care and sound financial management. Another incorrect approach that prioritizes short-term profitability over long-term financial health is also flawed. For example, an underwriter might be tempted to approve a policy for a company with aggressive accounting practices that boost current earnings but create future liabilities or cash flow issues. This focus on immediate gains, without considering the long-term implications for the insured and the insurer, is ethically questionable and can lead to regulatory scrutiny for failing to conduct thorough due diligence and for potentially engaging in practices that undermine the stability of the insurance market. A third incorrect approach that relies heavily on management's qualitative explanations without independent verification of the underlying financial data is also problematic. While management insights are valuable, they must be corroborated by the financial statements and other objective evidence. An underwriter who accepts management's narrative at face value, without critically examining the financial data for consistency and substance, is failing in their duty to conduct a rigorous and objective assessment. This can lead to underwriting decisions based on incomplete or biased information, which is a failure of professional responsibility and can contravene regulatory requirements for due diligence. The professional decision-making process for similar situations should involve a structured, multifaceted approach. First, thoroughly review all three core financial statements: balance sheet, income statement, cash flow statement, and understand their interdependencies. Second, analyze trends over multiple periods to identify patterns and deviations. Third, critically assess the quality of earnings and cash flows, looking for any signs of aggressive accounting or unsustainable practices. Fourth, consider the industry context and macroeconomic factors that might influence the company's financial performance. Fifth, seek clarification and independent verification for any areas of concern. Finally, document the rationale for the underwriting decision, ensuring it is supported by a comprehensive and objective analysis of the financial information. Question 4. The efficiency study reveals that the current underwriting process for complex commercial risks is taking longer than industry benchmarks, impacting the firm's ability to secure new business within desired timeframes. The underwriting team is considering streamlining the process by reducing the depth of analysis for certain categories of risk, focusing primarily on readily available historical loss data and excluding detailed operational assessments. Which of the following best represents a strategically sound and compliant approach to addressing this efficiency challenge? Option A. Implement a tiered review system where the depth of operational assessment is calibrated based on the complexity and potential impact of the risk, ensuring that high-impact risks still undergo thorough scrutiny while allowing for a more streamlined approach for lower-impact risks, supported by clear documentation and justification for any deviations from standard procedures. Option B. Prioritize securing new business by accepting risks with a higher degree of uncertainty, assuming that the overall profitability will balance out any potential losses from underpriced risks. Option C. Focus on reducing the number of underwriting staff to increase the workload per underwriter, thereby forcing them to process applications more quickly and efficiently. Option D. Accelerate the underwriting process by relying solely on automated data analysis and predefined risk scores, bypassing manual review of operational aspects for all commercial policies to meet efficiency targets. The correct answer is A. Implement a tiered review system where the depth of operational assessment is calibrated based on the complexity and potential impact of the risk, ensuring that high-impact risks still undergo thorough scrutiny while allowing for a more streamlined approach for lower-impact risks, supported by clear documentation and justification for any deviations from standard procedures. Explanation: this scenario is professionally challenging because it requires the underwriter to balance the need for accurate risk assessment with the pressure to meet business objectives, potentially leading to a conflict of interest. The underwriter must exercise sound judgment to ensure that the evaluation of risk is objective and not unduly influenced by commercial considerations. Adherence to regulatory requirements and ethical principles is paramount to maintaining market integrity and protecting policyholders. The correct approach involves a comprehensive and objective assessment of all relevant risk factors, utilizing a structured methodology that aligns with industry best practices and regulatory guidance. This ensures that pricing and terms accurately reflect the identified risks, preventing adverse selection and maintaining the financial stability of the insurer. Regulatory frameworks, such as those governing prudential regulation and conduct of business, mandate that underwriting decisions are based on sound risk principles and are not discriminatory or arbitrary. Ethical considerations also demand fairness and transparency in the underwriting process. An incorrect approach that prioritizes speed over thoroughness would fail to identify all significant risk exposures, leading to potentially inadequate pricing and increased claims volatility. This could violate regulatory requirements for prudent risk management and potentially expose the insurer to financial distress. Another incorrect approach that relies solely on historical data without considering emerging trends or unique client circumstances would be a failure to adapt to evolving risk landscapes. This could result in mispriced risks and a failure to meet the duty of care to policyholders by not offering appropriate coverage or terms. An approach that allows for subjective overrides of established underwriting guidelines without robust justification or documentation would also be problematic. This introduces an element of arbitrariness, potentially leading to inconsistent decision-making, regulatory scrutiny for unfair treatment of applicants, and a weakening of the insurer's risk management framework. Professionals should employ a decision-making framework that emphasizes a systematic, data-driven, and principle-based approach to risk assessment. This involves clearly defining risk appetite, establishing robust underwriting guidelines, utilizing appropriate analytical tools, and ensuring adequate training and oversight for underwriting staff. Regular review and adaptation of these processes in light of market changes and regulatory updates are also critical. When faced with competing pressures, professionals must prioritize regulatory compliance and ethical conduct, escalating concern, if necessary, to ensure that sound underwriting principles are upheld. Question 5. Comparative studies suggest that underwriters of financial institutions face complex decisions when evaluating potential capital raises for entities exhibiting signs of financial strain. A firm is seeking to underwrite a significant capital injection for a regional bank that has recently experienced a series of regulatory warnings regarding its lending practices and a decline in its net interest margin. The proposed capital is structured as a mix of common equity and subordinated debt, with the common equity component being relatively small. The underwriting firm stands to earn substantial fees from this transaction. Which of the following approaches best aligns with the principles of strategic underwriting in this scenario? Option A. Structure the underwriting to heavily favor the issuance of subordinated debt, as this offers a higher yield and thus greater immediate profitability for the underwriting syndicate. Option B. Decline the underwriting engagement due to the significant regulatory concerns and the weak capital structure, advising the bank to address its operational issues before seeking capital. Option C. Proceed with the underwriting, emphasizing the substantial fees and the bank's historical market presence, while conducting a cursory review of the recent regulatory warnings. Option D. Focus the underwriting efforts on securing a large equity issuance to immediately bolster the bank's capital ratios, even if it dilutes existing shareholders significantly. The correct answer is C. Proceed with the underwriting, emphasizing the substantial fees and the bank's historical market presence, while conducting a cursory review of the recent regulatory warnings. Explanation. This scenario presents a professional challenge because the underwriter must balance the immediate need for capital with the long-term solvency and reputational risks associated with underwriting a financial institution exhibiting concerning financial health. The underwriter's judgment is critical in assessing whether the proposed capital injection adequately mitigates the inherent risks, considering the institution's operational history and market perception. The correct approach involves a thorough, forward-looking assessment of the target financial institution's business model, risk management framework, and regulatory compliance, alongside the proposed capital structure. This approach is justified by the strategic underwriting exam's emphasis on prudential underwriting, which mandates that underwriters ensure the long-term viability and stability of the entities they support. Regulatory frameworks, such as those governing prudential regulation of financial institutions, require underwriters to act with due diligence and to avoid facilitating transactions that could jeopardize the financial system's stability or lead to future losses for investors and the underwriting firm. This involves scrutinizing the quality of capital, the institution's ability to generate sustainable earnings, and its adherence to all applicable laws and regulations. An incorrect approach that focuses solely on the immediate profitability of the underwriting deal, without adequately assessing the target institution's underlying risks, fails to meet the standards of prudential underwriting. This could lead to regulatory censure for facilitating a transaction that exposes the market to undue risk, or for failing to conduct adequate due diligence. Another incorrect approach that relies heavily on historical performance data without considering current market shifts and the institution's strategic response to them is also flawed. This ignores the dynamic nature of financial markets and regulatory expectations, potentially leading to underwriting a business that is no longer sustainable. Furthermore, an approach that prioritizes the client's desire for speed over a comprehensive risk assessment will be ethically unsound and likely violate regulatory requirements for robust due diligence. This demonstrates a failure to uphold professional integrity and a disregard for the potential systemic implications of underwriting a distressed financial institution. Professionals should employ a decision-making framework that begins with a comprehensive understanding of the regulatory landscape and the specific risks associated with underwriting financial institutions. This involves a multifaceted due diligence process that scrutinizes financial health, operational integrity, risk management capabilities, and compliance with all relevant laws and regulations. The decision to underwrite should be based on a reasoned assessment of the long-term viability and risk-adjusted return, rather than short-term gains or client pressure. A robust internal governance process, including independent review and sign-off, is also crucial to ensure that underwriting decisions are sound and compliant. Question 6. The audit findings indicate that the underwriting team for a proposed leveraged buyout, LBO, of a manufacturing company has focused heavily on the potential for significant advisory fees and has consequently streamlined the due diligence process, particularly concerning the target's long-term debt servicing capacity under stressed economic conditions. Which of the following approaches best aligns with the regulatory framework for strategic underwriting in this scenario? Option A. Conduct a comprehensive sensitivity analysis on the target's cash flows, stress testing debt service coverage ratios against various adverse economic scenarios and industry-specific challenges, and document all assumptions and findings rigorously. Option B. Focus on the exit strategy and potential for future capital appreciation, as this is the primary driver of value in LBOs, and assume debt will be refinanced if necessary. Option C. Rely on external credit ratings as the primary indicator of the target's ability to service its debt, as these are established by independent agencies. Option D. Proceed with the transaction, assuming the target's management has accurately projected future performance and that current market conditions will persist. The correct answer is D. Proceed with the transaction, assuming the target's management has accurately projected future performance and that current market conditions will persist. Explanation: this scenario is professionally challenging because it requires the underwriter to balance the pursuit of a profitable deal with the stringent regulatory obligations and ethical duties inherent in strategic underwriting, particularly concerning leveraged buyout (LBO) analysis. The pressure to close a significant transaction can create a temptation to overlook or downplay potential risks, especially those related to the target company's ability to service its debt. Adhering strictly to the regulatory framework is paramount to ensure market integrity and investor protection. The correct approach involves a comprehensive and objective assessment of the target company's financial health and its capacity to manage the proposed debt structure. This includes a thorough due diligence process that scrutinizes cash flow generation, debt service coverage ratios, and the sustainability of the business model under various economic scenarios. The regulatory framework for strategic underwriting mandates a prudent and well-documented risk assessment, ensuring that the underwriting decision is based on sound financial analysis and not solely on the potential for fees or deal closure. This approach aligns with the principles of responsible financial intermediation and the duty of care owed to investors. An incorrect approach that prioritizes deal completion over rigorous risk assessment would fail to meet regulatory standards. For instance, relying solely on management projections without independent verification, or applying overly optimistic assumptions to cash flow forecasts would constitute a breach of due diligence requirements. This could lead to misrepresentation of risk to investors and potential regulatory sanctions for the underwriting firm. Another incorrect approach would be to ignore or minimize red flags identified during due diligence, such as deteriorating industry trends or significant operational challenges, simply because they might jeopardize the transaction. This demonstrates a lack of professional skepticism and a failure to uphold the integrity of the underwriting process, which is a cornerstone of regulatory compliance. Professionals should employ a decision-making framework that begins with a clear understanding of the regulatory mandate for strategic underwriting and LBO analysis. This framework should emphasize objective risk assessment, thorough due diligence, and the documentation of all analytical steps and assumptions. It requires a commitment to professional skepticism, where potential risks are actively sought out and rigorously evaluated. When faced with conflicting pressures, such as the desire to close a deal versus the identification of significant risks, the framework dictates that regulatory compliance and ethical obligations take absolute priority. This involves clear communication with all stakeholders about identified risks and a willingness to walk away from a transaction if it cannot be structured and underwritten responsibly within the regulatory guidelines. Question 7. Investigation of a proposed transaction where a privately held technology company intends to raise capital through a series of private placements to accredited investors, followed by a potential initial public offering within 2 years. The company's management believes that each private placement will be structured to qualify for an exemption under Regulation D of the Securities Act of 1933. As the strategic underwriter, what is the most critical initial step to ensure compliance with both the Securities Act of 1933 and the Securities Exchange Act of 1934? Option A. Focus solely on the Securities Act of 1933 registration requirements for the private placements, deferring any consideration of the Securities Exchange Act of 1934 until the company is closer to its IPO. Option B. Advise the company to proceed with the private placements immediately, assuming that qualifying for Regulation D exemptions will negate any further disclosure obligations under the Securities Exchange Act of 1934. Option C. Conduct a thorough due diligence review to verify that each proposed private placement structure meets all the specific requirements for a Regulation D exemption, and to assess the company's readiness for potential public company reporting obligations. Option D. Confirm that the company has a robust internal compliance department capable of managing ongoing reporting requirements under the Securities Exchange Act of 1934. The correct answer is D. Confirm that the company has a robust internal compliance department capable of managing ongoing reporting requirements under the Securities Exchange Act of 1934. Explanation: this scenario presents a professional challenge because it requires an underwriter to navigate the complex interplay between the Securities Act of 1933 and the Securities Exchange Act of 1934, specifically concerning the registration requirements for securities offerings and the ongoing disclosure obligations. The challenge lies in accurately classifying the nature of the securities and the transaction to ensure compliance with both statutes, thereby preventing potential liability for unregistered offerings or inadequate disclosures. Strategic underwriting demands a deep understanding of these foundational securities laws to advise clients appropriately and structure transactions in a compliant manner. The correct approach involves a thorough review of the proposed transaction to determine if the securities being offered fall under an exemption from registration under the Securities Act of 1933. If no exemption applies, the underwriter must ensure that a registration statement is properly filed and declared effective by the Securities and Exchange Commission (SEC) before the securities can be offered to the public. Furthermore, the underwriter must consider the implications of the Securities Exchange Act of 1934, particularly regarding the continuous reporting obligations that may arise for the issuer post-offering, such as filing periodic reports, e.g., 10K, 10Q, 8K. This approach is correct because it directly addresses the core mandates of both acts. The Securities Act of 1933 governs the initial offering and sale of securities, and the Securities Exchange Act of 1934 governs the secondary market and ongoing issuer disclosures. Adherence to these principles ensures that investors receive adequate information and that the offering is conducted legally. An incorrect approach would be to assume that private placement automatically exempts the offering from all registration requirements without a detailed analysis of the specific conditions of the exemption e.g., Regulation D. This is a regulatory failure because exemptions are narrowly construed, and failing to meet all criteria can render the offering unregistered and illegal. Another incorrect approach would be to focus solely on the initial offering under the Securities Act of 1933 and disregard the potential ongoing disclosure obligations under the Securities Exchange Act of 1934. This is an ethical and regulatory failure as it leaves the issuer and potentially the underwriter exposed to liability for non-compliance with reporting requirements, which are crucial for maintaining market integrity and investor protection. A third incorrect approach would be to rely on informal assurances from the issuer's counsel without conducting independent due diligence to verify the legal basis for any claimed exemptions or the issuer's preparedness for ongoing compliance. This is a professional failure as it abdicates the underwriter's responsibility to ensure compliance and can lead to significant legal and reputational damage. The professional decision-making process for similar situations should begin with a comprehensive understanding of the client's proposed transaction and the nature of the securities involved. This requires a detailed review of all relevant documentation and discussions with the issuer and their legal counsel. The underwriter must then meticulously assess whether the offering qualifies for any exemptions from registration under the Securities Act of 1933, applying the specific rules and interpretations of those exemptions. If no exemption is available, the process must pivot to ensuring a compliant registration statement is prepared and filed. Concurrently, the underwriter must consider the issuer's obligations under the Securities Exchange Act of 1934, both in the context of the offering and for the period following the offering, to ensure the issuer is capable of meeting these ongoing disclosure requirements. This systematic, fact-driven, and legally grounded approach is essential for mitigating risk and upholding professional standards. Question 8. Benchmark analysis indicates that a key competitor has recently launched a new product with a significantly lower premium for a comparable risk profile. The sales team is advocating for an immediate, aggressive price reduction to match or beat this competitor's offering to prevent market share erosion. As the strategic underwriter, what is the most appropriate course of action to ensure both competitive positioning and regulatory compliance? Option A. Conduct a detailed analysis of the competitor's product features, target market, and apparent underwriting philosophy, alongside an internal review of our own cost structure, risk appetite, and pricing models to determine if a strategic adjustment is feasible and sustainable. Option B. Inform the sales team that market share is less important than maintaining current profit margins and instruct them to focus on selling existing products at current prices, disregarding the competitor's actions. Option C. Immediately reduce premiums across the board to match the competitor's new offering, as instructed by the sales team, to secure market share and avoid customer attrition. Option D. Implement a superficial price reduction on a limited range of products that are less profitable, hoping to appease the sales team and deter the competitor without significantly impacting overall profitability or risk exposure. The correct answer is A. Conduct a detailed analysis of the competitor's product features, target market, and apparent underwriting philosophy, alongside an internal review of our own cost structure, risk appetite, and pricing models, to determine if a strategic adjustment is feasible and sustainable. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the underwriter to balance the need for competitive pricing with the fundamental duty to accurately assess risk and ensure the long-term viability of the insurance product. Misjudging the competitive landscape can lead to underpricing, which erodes profitability and potentially leads to insolvency or overpricing, which results in lost market share. The underwriter must navigate conflicting pressures from sales teams seeking market penetration and management focused on financial stability. This requires a nuanced understanding of market dynamics, competitor strategies, and the underlying risk factors, all while adhering to regulatory requirements for fair pricing and solvency. Correct approach analysis. The correct approach involves a comprehensive analysis of competitor pricing, product features, and target markets, combined with a thorough assessment of the underwriter's own risk appetite, capacity, and cost structure. This approach ensures that pricing decisions are informed by both external market realities and internal capabilities, leading to a sustainable competitive advantage. Regulatory justification stems from the principle of prudent underwriting, which mandates that insurers set premiums that are adequate to cover claims and expenses and to maintain solvency. This also aligns with the duty to treat customers fairly by not exploiting market power to charge excessive premiums. Incorrect approach is analysis. An approach that solely focuses on matching competitor pricing without a deep understanding of their underlying cost structures or risk profiles is professionally unacceptable. This can lead to a race to the bottom, where premiums become insufficient to cover claims, violating solvency regulations and potentially leading to financial distress. It also fails to account for differences in the underwriter's own operational efficiency or risk appetite. An approach that prioritizes immediate market share gains by significantly undercutting competitors, even if it means accepting higher risks or lower margins, is also flawed. This demonstrates a disregard for prudent underwriting principles and can expose the insurer to unacceptable levels of risk, potentially jeopardizing its ability to meet future obligations to policyholders, which is a direct contravention of solvency and consumer protection regulations. An approach that relies on anecdotal evidence or the opinions of the sales team without rigorous data analysis to set pricing is professionally unsound. This lacks the objectivity required for sound underwriting and can lead to pricing decisions that are either uncompetitive or inadequately priced for the risk, both of which have negative regulatory implications. Professional reasoning. Professionals should adopt a data-driven and risk-informed approach. This involves gathering and analyzing comprehensive market intelligence, understanding competitor strategies, and critically evaluating the underwriter's own capabilities and risk appetite. Pricing decisions should be a strategic outcome of this analysis, ensuring that they are competitive, profitable, and compliant with all regulatory requirements, particularly those related to solvency and fair customer treatment. A structured process of risk assessment, market analysis, and financial modeling, reviewed by senior management and actuarial functions, is essential for making sound strategic underwriting decisions. Question 9. System analysis indicates that an energy underwriter is reviewing a portfolio of new business applications for a renewable energy development company. The company is seeking coverage for a large-scale solar farm project that utilizes a novel energy storage technology. The underwriter needs to determine the most effective process optimization strategy to ensure accurate risk assessment and profitable underwriting within the current regulatory framework. Option A. Utilize a standardized underwriting checklist designed for established utility infrastructure, applying the same risk parameters to the solar farm project regardless of its unique technological components or the specific regulatory environment for renewable energy. Option B. Implement a rigorous, multifaceted risk assessment process that incorporates forward-looking analysis of technological performance, regulatory incentives and mandates, and potential supply chain disruptions specific to the novel storage technology, alongside traditional loss data. Option C. Focus exclusively on the project's projected revenue streams and the client's financial statements, assuming that strong financial performance inherently mitigates all underwriting risks. Option D. Prioritize rapid policy issuance to capture market share, relying primarily on historical loss data from conventional energy projects and applying a broad risk appetite without detailed investigation into the novel storage technology. The correct answer is B. Implement a rigorous, multifaceted risk assessment process that incorporates forward-looking analysis of technological performance, regulatory incentives and mandates, and potential supply chain disruptions specific to the novel storage technology, alongside traditional loss data. Explanation. This scenario presents a professional challenge due to the inherent volatility and complex risk profiles within the energy sector, particularly in strategic underwriting. Underwriters must balance the need for profitable business acquisition with the imperative to accurately assess and price risks, ensuring the long-term solvency of the insurer and the stability of the insured entities. The strategic element lies in identifying opportunities for growth and market penetration while maintaining underwriting discipline. Regulatory compliance is paramount, requiring adherence to specific guidelines that govern risk assessment, policy wording, and capital adequacy. The challenge is amplified by the dynamic nature of energy markets, influenced by geopolitical events, technological advancements, and evolving environmental regulations. The correct approach involves a comprehensive, data-driven risk assessment that integrates forward-looking analysis of market trends, technological viability, and regulatory changes impacting renewable energy projects. This approach prioritizes understanding the specific risks associated with each energy subsector, oil and gas, renewables, utilities, and tailoring underwriting strategies accordingly. It emphasizes the development of robust risk mitigation strategies and clear policy terms that reflect the unique exposures. This aligns with the strategic underwriting exam's focus on optimizing processes for sustainable profitability and risk management, ensuring that underwriting decisions are informed by a deep understanding of the underlying business and its operating environment, thereby meeting regulatory expectations for prudent risk management and fair customer treatment. An incorrect approach that focuses solely on historical loss data, without considering emerging risks in the renewable sector, would fail to adequately price the unique challenges of new technologies and evolving regulatory landscapes. This could lead to underpricing of risk, potentially resulting in significant financial losses for the insurer and noncompliance with regulatory requirements for accurate risk assessment. Another incorrect approach that prioritizes market share growth above all else, leading to the acceptance of risks without sufficient due diligence or appropriate pricing, would violate the fundamental principles of sound underwriting. This could expose the insurer to unacceptable levels of risk, jeopardizing its financial stability and potentially leading to regulatory intervention due to inadequate risk management practices. A third incorrect approach that relies on standardized underwriting criteria across all energy subsectors, without acknowledging the distinct risk profiles of oil and gas versus renewables, would be a significant oversight. This lack of specialization would lead to mispriced risks and potentially inadequate coverage, failing to meet the specific needs of clients and the regulatory expectation for tailored risk assessment. Professionals should adopt a decision-making process that begins with a thorough understanding of the strategic objectives of the underwriting function and the specific regulatory framework governing their operations. This involves a continuous cycle of risk identification, assessment, pricing, and monitoring, informed by market intelligence, technological expertise, and a commitment to ethical underwriting practices. The process should be iterative, allowing for adjustments based on new information and evolving market conditions, always prioritizing the long-term health of the business and the protection of policyholders. Question 10. The review process indicates that an underwriter is evaluating a strategic acquisition of a technology company. The target company has a strong track record of innovation, but is not yet profitable, making traditional earnings-based multiples challenging to apply directly. The underwriter is considering several valuation approaches. Which approach is most likely to be considered the most robust and professionally sound in this context, adhering to typical regulatory expectations for strategic underwriting? Option A. Using a revenue multiple derived from a single, recently announced acquisition in a slightly different but related industry. Option B. Relying primarily on a discounted cash flow (DCF) analysis, projecting future cash flows based on aggressive growth assumptions and a high terminal value. Option C. Employing a combination of comparable company analysis and precedent transaction analysis, adjusting multiples for differences in growth potential, market position, and the absence of current profitability. Option D. Focusing exclusively on the net asset value of the target company, as this provides a tangible and objective measure of worth. The correct answer is B. Relying primarily on a discounted cash flow (DCF) analysis, projecting future cash flows based on aggressive growth assumptions and a high terminal value. Explanation. This scenario presents a professional challenge because the underwriter must select the most appropriate valuation technique for a strategic acquisition, considering the specific characteristics of the target company and the market. The choice of valuation method directly impacts the offer price, the negotiation leverage, and ultimately the success of the acquisition. Misapplication of valuation techniques can lead to overpaying, underpaying, or failing to identify key risks, all of which have significant financial and reputational consequences for the firm and its clients. Adherence to regulatory frameworks and ethical guidelines is paramount to ensure fair and transparent dealings. The correct approach involves using a combination of valuation techniques, with a strong emphasis on comparable companies and precedent transactions, as these are widely accepted and regulated methods for valuing businesses in strategic acquisition contexts. This approach is justified by regulatory frameworks that emphasize the need for robust, defensible valuations based on market data and established methodologies. For instance, in the UK, the Takeover Code and guidance from the Panel on Takeovers and Mergers, as well as professional bodies like the CISI, stress the importance of using appropriate valuation methods that reflect current market conditions and the specific circumstances of the transaction. Comparable company analysis provides a market-based perspective by looking at the multiples of similar publicly traded companies, while precedent transactions offer insights into what buyers have paid for similar businesses in the past. A skilled underwriter will triangulate these methods, adjusting for differences in size, growth, profitability, and market position, to arrive at a well-supported valuation range. An approach that relies solely on discounted cash flow (DCF) analysis without sufficient consideration for market comparables or precedent transactions would be professionally deficient. While DCF is a valid valuation method, its reliance on future projections makes it highly sensitive to assumptions about growth rates, discount rates, and terminal values. Without grounding these projections in observable market data from comparable companies and recent transactions, the DCF valuation can become overly speculative and less defensible, potentially violating regulatory expectations for objective and evidence-based valuation. Similarly, an approach that prioritizes internal asset-based valuation without adequately considering market multiples or transaction precedents would be inappropriate for a strategic acquisition. Asset-based valuations are typically more relevant for distressed companies or those with significant tangible assets, rather than for businesses where goodwill, brand value, and future earnings potential are key drivers of value. Relying solely on this method for strategic acquisition would fail to capture the strategic premium or market perception of the target, leading to a potentially inaccurate and uncompetitive offer price, and could be seen as a failure to conduct due diligence in line with market practice and regulatory expectations. The professional decision-making process for similar situations should involve a thorough understanding of the target company's business, industry dynamics, and the strategic rationale for the acquisition. This should be followed by a critical assessment of available valuation methodologies, considering their strengths, weaknesses, and applicability to the specific transaction. The underwriter must then select and apply the most appropriate methods, ensuring that the assumptions used are reasonable and well supported by market data and expert judgment. Finally, the valuation should be stress-tested and presented with clear disclosures of the methodologies used and the key assumptions made, in accordance with regulatory and ethical standards. Question 11. Cost-benefit analysis shows that launching a new, highly leveraged investment product could significantly boost short-term profits for the firm. However, prevailing economic indicators suggest a potential for increased market volatility in the coming year, and the product's structure might encourage speculative behavior among a segment of the target market. Which approach best aligns with strategic underwriting principles and regulatory expectations? Option A. Proceed with the launch, emphasizing the immediate profit potential and assuming market volatility will be manageable. Option B. Delay the launch to conduct further research into the product's long-term market impact and potential regulatory implications, exploring alternative product structures that mitigate speculative risks. Option C. Launch the product immediately to capitalize on the current market opportunity, with a plan to adjust marketing strategies if market conditions deteriorate. Option D. Focus solely on the projected revenue figures in the cost-benefit analysis, as this represents the primary driver for strategic product development. The correct answer is A. Proceed with the launch, emphasizing the immediate profit potential and assuming market volatility will be manageable. Explanation: this scenario is professionally challenging because it requires an underwriter to balance the immediate financial benefits of a new product launch against potential long-term market instability and regulatory scrutiny. Strategic underwriting demands a forward-looking perspective that considers not just profitability, but also the broader economic impact and adherence to regulatory principles designed to protect market integrity and consumers. Careful judgment is required to avoid short-sighted decisions that could lead to future financial losses or regulatory sanctions. The correct approach involves a comprehensive assessment of both direct and indirect economic impacts, considering how the new product might influence competitor strategies, consumer behavior, and overall market equilibrium. This includes evaluating potential systemic risks, the product's alignment with market trends, and its long-term sustainability. Regulatory frameworks, such as those governing financial markets and consumer protection, emphasize prudence, fairness, and the avoidance of practices that could destabilize markets or exploit consumers. A strategic underwriter must ensure that the product's introduction is not only profitable, but also ethically sound and compliant with these overarching principles. An incorrect approach would be to solely focus on the projected short-term revenue gains without adequately considering the potential for market disruption or negative externalities. This could lead to regulatory breaches if the product, for instance, creates an unfair competitive advantage or exposes consumers to undue risk that was not properly disclosed or mitigated. Another incorrect approach is to prioritize speed to market over thorough risk assessment, potentially overlooking critical economic indicators or market vulnerabilities. This haste could result in a product that is ill-suited for the prevailing economic climate, leading to higher-than-expected claims or a failure to achieve projected sales, thereby undermining the initial cost-benefit analysis and potentially violating principles of sound financial management and market conduct. Professionals should adopt a decision-making framework that integrates economic forecasting, market intelligence, and regulatory compliance. This involves scenario planning to understand potential market reactions, stress-testing the product's viability under various economic conditions, and consulting with legal and compliance teams to ensure full adherence to all applicable regulations. The process should prioritize a holistic view, where the cost-benefit analysis is a starting point, not the sole determinant, for strategic underwriting decisions. Question 12. Assessment of how a proposed large-scale renewable energy infrastructure project's potential supply chain vulnerabilities and community engagement challenges, beyond direct physical damage from extreme weather, could materially impact its long-term operational viability and thus the insurer's risk exposure. Option A. Conduct a detailed analysis of the project's supply chain resilience, including the sourcing of critical components and the potential for geopolitical disruptions or labor disputes affecting their delivery, alongside an assessment of the project's stakeholder engagement strategy and its capacity to mitigate social license to operate risks. Option B. Prioritize the immediate premium income generated by the policy, accepting the project's stated operational plans without independent verification of its ESG-related risk mitigation strategies. Option C. Focus exclusively on the project's historical operational performance data and its current insurance claims history, assuming past performance is indicative of future risk. Option D. Treat supply chain and community engagement risks as non-insurable externalities, focusing only on direct physical damage coverage and excluding any consideration of these broader operational factors. Correct answer is A. Conduct a detailed analysis of the project's supply chain resilience, including the sourcing of critical components and the potential for geopolitical disruptions or labor disputes affecting their delivery, alongside an assessment of the project's stakeholder engagement strategy and its capacity to mitigate social license to operate risks. Explanation: this scenario is professionally challenging because it requires underwriters to move beyond traditional financial risk assessment to incorporate forward-looking, non-financial factors that can have significant long-term impacts on an insurer's solvency and reputation. The strategic underwriting exam emphasizes the integration of ESG factors, which are increasingly material to business operations and investment performance. Navigating the evolving regulatory landscape and the qualitative nature of ESG data demands robust judgment and a structured approach to impact assessment. The correct approach involves a comprehensive, forward-looking assessment of how specific ESG risks and opportunities could materially affect the insured's business operations, financial performance, and ultimately the insurer's exposure. This includes identifying potential physical risks, e.g., climate change impacts on infrastructure, transition risks, e.g., regulatory changes impacting carbon-intensive industries, social risks, e.g., labor disputes, supply chain disruptions, and governance risks, e.g., poor board oversight. It also considers ESG opportunities that might enhance resilience or create new markets. This aligns with the strategic imperative to underwrite for long-term sustainability and profitability, as mandated by evolving regulatory expectations that increasingly require insurers to consider systemic risks and their impact on financial stability. An approach that focuses solely on historical claims data without considering the potential for future ESG-related disruptions is incorrect. This fails to meet the strategic underwriting requirement of anticipating emerging risks and can lead to underpricing of risk and inadequate reserving. It represents a failure to comply with the spirit, if not the letter, of regulations that encourage proactive risk management and consideration of systemic factors. An approach that prioritizes short-term premium targets over a thorough ESG risk assessment is also incorrect. This demonstrates a lack of strategic foresight and can expose the insurer to significant unmanaged liabilities. It prioritizes immediate financial gain over long-term solvency and adherence to responsible underwriting practices, potentially violating principles of prudent risk management. An approach that dismisses ESG factors as purely reputational or non-financial is fundamentally flawed. Modern regulatory frameworks and industry best practices recognize that ESG factors are increasingly material financial risks and opportunities that can directly impact an insurer's balance sheet and future viability. Ignoring these factors constitutes a failure to conduct a complete and accurate risk assessment. Professionals should adopt a decision-making framework that integrates ESG considerations into the core underwriting process. This involves developing clear methodologies for identifying, assessing, and quantifying ESG risks and opportunities, establishing internal expertise or partnerships for ESG data analysis, and ensuring that underwriting guidelines reflect the strategic importance of these factors. Regular review and adaptation of these methodologies are crucial to keep pace with evolving ESG landscapes and regulatory expectations. Question 13. Upon reviewing the strategic plan to enhance underwriting efficiency, what approach best aligns with the principles of consumer protection laws in the UK, specifically concerning transparency and fairness in the insurance application process? Option A. Implementing a fully automated underwriting system that significantly reduces processing times, with all policy terms and conditions available via a link on the insurer's website. Option B. Developing a streamlined application process that uses clear, concise language and provides clear explanations of key policy features and exclusions, with dedicated support channels for consumer queries. Option C. Prioritizing speed of decision-making by limiting the scope of information gathered during the application, relying on post-inception data for any necessary adjustments. Option D. Reducing the number of questions on the application form to expedite submission, assuming consumers will seek clarification on complex terms if needed. Correct answer is A. Implementing a fully automated underwriting system that significantly reduces processing times, with all policy terms and conditions available via a link on the insurer's website. Explanation: this scenario is professionally challenging because it requires balancing the strategic objective of optimizing underwriting processes with the paramount duty to protect consumers. Underwriting efficiency must not come at the expense of regulatory compliance and ethical treatment of policyholders. Careful judgment is required to ensure that process improvements do not inadvertently create barriers to access, lead to unfair discrimination, or obscure critical policy terms and conditions from consumers. The correct approach involves a thorough review of existing underwriting processes to identify potential areas for efficiency gains, while simultaneously assessing the impact on consumer protection. This includes evaluating how changes might affect the clarity of information provided to consumers, the fairness of underwriting decisions, and the accessibility of the underwriting process. Regulatory justification stems from the fundamental principles of consumer protection embedded in insurance law, which mandate transparency, fairness, and non-discrimination. For example, regulations often require clear and understandable policy documentation, prohibit unfair discrimination based on protected characteristics, and ensure that consumers are not misled about policy coverage or exclusions. Optimizing processes in this manner ensures adherence to these principles. An incorrect approach that prioritizes speed and cost reduction without considering consumer impact is professionally unacceptable. This could involve automating decision-making without adequate human oversight, leading to potentially unfair or discriminatory outcomes that violate consumer protection laws. Another incorrect approach might be to simplify policy language to the point of ambiguity or omission, thereby failing to adequately inform consumers of their rights and obligations, which contravenes disclosure requirements. Furthermore, an approach that streamlines the application process by removing opportunities for consumers to ask questions or receive clarification could be seen as creating an unfair disadvantage, potentially violating principles of good faith and fair dealing. Professionals should adopt a decision-making framework that integrates consumer protection considerations into every stage of process optimization. This involves proactive risk assessment, stakeholder consultation, including consumer representatives where appropriate, and ongoing monitoring of the impact of implemented changes. The framework should prioritize adherence to regulatory requirements and ethical standards, ensuring that efficiency gains are achieved responsibly and sustainably, without compromising consumer welfare. Question 14. The evaluation methodology shows a tendency to present credit risk reporting by focusing on the most granular data points available, irrespective of their direct impact on strategic underwriting decisions or specific regulatory disclosure requirements. Which approach best aligns with the principles of strategic underwriting and regulatory compliance for this exam? Option A. Aggregate all available credit risk data into a single comprehensive report to provide the broadest possible overview of the institution's credit exposure. Option B. Prioritize reporting on credit risk metrics that are explicitly mandated by the strategic underwriting exam's regulatory framework and directly inform strategic underwriting decisions, ensuring clarity and conciseness. Option C. Emphasize extensive qualitative commentary on credit risk trends, supported by anecdotal evidence rather than specific quantitative data points. Option D. Focus exclusively on the most recent credit risk indicators, highlighting immediate changes without considering historical context or forward-looking projections. The correct answer is B. Prioritize reporting on credit risk metrics that are explicitly mandated by the strategic underwriting exam's regulatory framework and directly inform strategic underwriting decisions, ensuring clarity and conciseness. Explanation: this scenario is professionally challenging because it requires an underwriter to balance the need for comprehensive credit risk reporting with the specific disclosure requirements mandated by the strategic underwriting exam's regulatory framework. The challenge lies in identifying the precise level of detail that is both informative for strategic decision-making and compliant with regulatory expectations, avoiding both overdisclosure that could be misleading or burdensome and underdisclosure that could obscure material risks. Careful judgment is required to interpret the nuances of regulatory guidance on credit risk reporting and disclosure. The correct approach involves a focused review of the credit risk reporting framework, specifically identifying disclosures that directly inform strategic underwriting decisions and are explicitly required or permitted by the relevant regulatory guidelines for the strategic underwriting exam. This approach is right because it prioritizes regulatory compliance and the strategic utility of the information. It ensures that the reporting aligns with the principles of transparency and accuracy expected by regulators, while also providing actionable insights for underwriting strategy. The regulatory justification stems from the exam's emphasis on adhering to established reporting standards and demonstrating an understanding of how credit risk information supports strategic underwriting. An incorrect approach that focuses solely on aggregating all available credit risk data without regard for strategic relevance or specific disclosure mandates fails, because it risks overwhelming stakeholders with non-essential information and may not meet the specific reporting objectives. This could lead to a failure to highlight critical risks or opportunities, thereby undermining the strategic purpose of the reporting. Ethically, it could be seen as a failure to provide clear and concise information. Another incorrect approach that prioritizes disclosing only the most recent credit risk indicators, ignoring historical trends or forward-looking assessments, is flawed because it presents an incomplete picture. Regulatory frameworks often require a holistic view of credit risk, encompassing both current status and potential future developments. This approach could lead to misjudgments by obscuring the underlying drivers of risk or the potential for future deterioration. A third incorrect approach that involves extensive qualitative commentary without grounding it in quantitative data or specific regulatory reporting categories is also problematic. While qualitative insights are valuable, they must be supported by verifiable data and presented within the established reporting structure to be considered robust and compliant. Without this, the commentary may be perceived as subjective or lacking in substance, failing to meet the rigor expected in strategic credit risk reporting. Professionals should adopt a decision-making framework that begins with a thorough understanding of the specific regulatory requirements for credit risk reporting and disclosure relevant to the strategic underwriting exam. This involves consulting the official guidance and understanding the purpose behind each disclosure. Next, they should assess the available credit risk data and identify which elements are most pertinent to strategic underwriting decisions, such as portfolio performance, concentration risks, and emerging trends. Finally, they must synthesize this information, ensuring that the reporting is both compliant with regulatory mandates and effectively communicates the strategic implications of the credit risk profile. Question 15. Performance analysis shows a significant portion of an underwriter's book of business comes from a single, long-standing client. This client is requesting a substantial deviation from standard underwriting guidelines for new policy, citing competitive pressures and the need for expediency. The underwriter recognizes that approving this deviation without rigorous scrutiny could introduce material, unpriced risk to the insurer. What is the most appropriate course of action for the underwriter in this situation? Option A. Reject the request outright without further investigation, citing the need to adhere strictly to established underwriting guidelines to avoid any potential risk. Option B. Conduct a comprehensive, objective risk assessment of the client's specific request, documenting all findings and potential implications, and communicate the outcome transparently to the client. Exploring alternative solutions if the deviation cannot be approved as requested. Option C. Agree to the deviation based on the client's assurance that the risk is manageable, and document the approval informally to expedite the process. Option D. Immediately approve the deviation to maintain the client relationship and secure the renewal business, as the client's historical performance has been profitable. The correct answer is B. Conduct a comprehensive, objective risk assessment of the client's specific request, documenting all findings and potential implications, and communicate the outcome transparently to the client, exploring alternative solutions if the deviation cannot be approved as requested. Explanation. This scenario is professionally challenging because it requires balancing competing interests. the need to maintain client relationships and business revenue against the imperative to act with integrity and avoid conflicts of interest. The underwriter must navigate a situation where a long-standing client, whose business is significant, is requesting a deviation from standard underwriting practices that could expose the insurer to undue risk. Careful judgment is required to uphold the principles of sound underwriting and regulatory compliance without unnecessarily alienating a valuable client. The correct approach involves a thorough, objective risk assessment of the client's request, documented clearly and communicated transparently. This approach upholds the underwriter's fiduciary duty to the insurer to manage risk prudently and to adhere to the company's underwriting guidelines and risk appetite. It aligns with regulatory expectations that insurers operate on sound financial principles and avoid taking on risks that are not adequately understood or priced. Specifically, it demonstrates adherence to principles of good governance and risk management, which are implicitly or explicitly required by regulatory frameworks governing insurance operations, ensuring that decisions are based on objective risk factors rather than personal relationships or commercial pressures. An incorrect approach that prioritizes the client relationship over objective risk assessment would fail to uphold the underwriter's duty to the insurer. This could lead to adverse selection and financial losses for the company, potentially breaching solvency requirements and regulatory obligations to maintain a sound financial position. Another incorrect approach, such as immediately rejecting the request without a thorough review, might damage the client relationship unnecessarily and fail to explore potential alternative solutions that could still meet the insurer's risk appetite. A third incorrect approach, agreeing to the deviation without proper documentation or justification, would create a precedent for future noncompliance and could be viewed as a failure of internal controls and risk management, exposing the underwriter and the insurer to regulatory scrutiny. Professionals should employ a decision-making framework that begins with understanding the request and its implications. This involves consulting internal guidelines, assessing the specific risks presented, and considering potential mitigation strategies. Transparency with the client about the underwriting process and the rationale behind decisions is crucial. If a deviation is considered, it must be supported by robust data and a clear justification that aligns with the insurer's risk appetite and regulatory obligations. Escalation to senior management or a dedicated risk committee may be necessary for significant deviations. Question 16. Implementation of a new credit scoring system by a strategic underwriting team provided by a third-party vendor has led to a significant increase in loan approvals, meeting a key business objective. However, internal review raises concerns that the model might be disproportionately impacting certain demographic groups, even though the vendor claims the model is compliant and unbiased. The underwriting manager is under pressure to maintain the increased approval rates. What is the most ethically and regulatorily sound approach for the underwriting team? Option A. Conduct an independent validation of the credit scoring model's outputs to identify and mitigate any potential biases, regardless of the vendor's assurances or the pressure to maintain approval rates. Option B. Prioritize meeting the increased loan approval targets by downplaying or ignoring any subtle indications of bias in the model's performance. Option C. Make subjective adjustments to individual loan applications that appear to be negatively impacted by the scoring system, without a systematic review of the model itself. Option D. Accept the vendor's assurance of compliance and focus on managing the increased loan portfolio, as the primary business objective has been met. The correct answer is A. Conduct an independent validation of the credit scoring model's outputs to identify and mitigate any potential biases, regardless of the vendor's assurances or the pressure to maintain approval rates. Explanation. This scenario presents a professional challenge because it pits the pursuit of business objectives against the ethical imperative of fair and unbiased credit assessment. The underwriting team is under pressure to increase loan approvals, which could lead to overlooking potential risks or, more critically, introducing bias into the credit scoring system. The core of the challenge lies in ensuring that the credit scoring model, while efficient, remains objective, transparent, and compliant with regulatory requirements designed to prevent discrimination. Careful judgment is required to balance business needs with ethical responsibilities and legal obligations. The correct approach involves a thorough review and validation of the credit scoring model's outputs, focusing on identifying and mitigating any potential biases, particularly those related to protected characteristics. This approach is right because it directly addresses the regulatory and ethical duty to ensure fair lending practices. Specifically, under the relevant regulatory framework for strategic underwriting, it is imperative to demonstrate that credit decisions are based on sound, objective criteria and do not result in disparate impact on individuals based on race, religion, gender, or other protected classes. Proactive identification and remediation of bias in scoring models are essential to avoid regulatory sanctions, reputational damage, and the erosion of customer trust. An incorrect approach that relies solely on the vendor's assurance without independent verification fails to meet the duty of due diligence. This approach is ethically flawed as it abdicates responsibility for the integrity of the underwriting process and is regulatorily unsound, as the onus is on the firm to ensure compliance, not on a third-party vendor. Another incorrect approach that prioritizes meeting the business target of increased loan approvals by downplaying or ignoring potential biases in the scoring model is ethically reprehensible and legally perilous. This prioritizes short-term business gains over fundamental fairness and compliance, risking significant penalties and undermining the principles of responsible lending. A further incorrect approach that involves making ad hoc adjustments to individual loan applications based on subjective criteria, rather than addressing systemic issues within the scoring model, is also problematic. While seemingly aimed at fairness, it introduces inconsistency and can lead to arbitrary decision-making, potentially creating new forms of bias and making the underwriting process opaque and difficult to defend. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the business objective and its potential implications for underwriting practices. 2. Review the credit scoring model and its underlying logic for any inherent biases or potential for disparate impact. 3. Conduct independent validation and testing of the model's outputs, specifically looking for patterns that suggest bias against protected groups. 4. Engage with the vendor to understand their validation processes and address any identified concerns. 5. If biases are detected, implement corrective actions, which may include model recalibration, data adjustments, or the development of supplementary decisioning rules. 6. Document all steps taken, including the rationale for decisions and the outcomes of validation and remediation efforts. 7. Ensure ongoing monitoring of the credit scoring system to maintain fairness and compliance. Question 17. Which approach would be most appropriate for a strategic underwriter to assess the financial health and risk profile of a company, ensuring compliance with the regulatory framework for the strategic underwriting exam? Option A. A comprehensive analysis of liquidity, solvency, profitability, and efficiency ratios, interpreted within the specific industry context and regulatory environment. Option B. A primary focus on efficiency ratios to gauge the effectiveness of the company's operations and resource utilization. Option C. A review of historical liquidity ratios to ensure the company can meet its immediate short-term obligations. Option D. An in-depth examination of profitability ratios to identify the company's earnings potential and growth prospects. The correct answer is A. A comprehensive analysis of liquidity, solvency, profitability, and efficiency ratios, interpreted within the specific industry context and regulatory environment. Explanation. This scenario is professionally challenging because strategic underwriting requires a nuanced understanding of a company's financial health beyond simple historical performance. Underwriters must assess the forward-looking implications of financial ratios, considering the specific regulatory environment and the strategic objectives of the underwriting engagement. Simply relying on a single type of ratio analysis or a superficial review of trends without considering the underlying business context and regulatory expectations would be a failure. The correct approach involves a comprehensive analysis of liquidity, solvency, profitability, and efficiency ratios, interpreted within the context of the specific industry, economic conditions, and the regulatory framework governing the strategic underwriting exam. This approach is justified by the regulatory requirement to conduct thorough due diligence and provide a well-reasoned assessment of risk. For instance, under UK regulations relevant to financial services, a robust understanding of a firm's financial resilience, as indicated by a balanced view of its various financial ratios, is paramount for ensuring market integrity and protecting investors. This holistic view, allows for the identification of potential vulnerabilities that might not be apparent from examining only one category of ratios, thereby fulfilling the duty of care expected of strategic underwriters. An approach that focuses solely on profitability ratios would be incorrect, because it neglects the critical aspects of a company's ability to meet its short-term obligations, liquidity, and its long-term financial stability, solvency. This oversight could lead to an underestimation of default risk, a failure to comply with prudential requirements, and ultimately, a misrepresentation of the true financial standing of the entity being underwritten. Similarly, an approach that prioritizes efficiency ratios without considering liquidity or solvency would be flawed. While efficiency is important for operational performance, a highly efficient company that cannot meet its debts is a significant risk. This narrow focus fails to address the fundamental stability and risk profile required by regulatory bodies overseeing strategic underwriting. An approach that merely calculates ratios without interpreting them in the context of the firm's strategic goals and the prevailing regulatory landscape would also be insufficient, as it would not demonstrate the strategic insight expected of an underwriter. The professional decision-making process for similar situations should involve a structured, multifaceted analysis. This begins with clearly defining the scope and objectives of the underwriting engagement, followed by the systematic collection of relevant financial data. The underwriter must then apply a range of ratio analyses, critically interpreting the results in light of industry benchmarks, economic forecasts, and the specific regulatory requirements of the jurisdiction. Crucially, the analysis must be forward-looking, considering how current financial health and trends translate into future risk and opportunity, and how these align with the strategic objectives of the transaction. This comprehensive and context-aware approach ensures compliance with regulatory standards and upholds professional integrity. Question 18. The analysis reveals that a significant portion of the insurer's portfolio is exposed to a confluence of interconnected, low-probability but high-impact events, such as a rapid increase in interest rates coupled with a severe cyber attack on critical infrastructure. The underwriting team is debating the extent to which this specific, complex scenario should influence capital allocation and pricing strategies. Given that such an event has no direct historical precedent in the available data, which of the following represents the most strategically sound and regulatorily compliant approach to addressing this sensitivity? Option A. Develop and implement a bespoke stress test scenario that models the combined impact of these events, assess the potential capital depletion, and adjust pricing and capital reserves accordingly to ensure solvency under such extreme conditions. Option B. Defer significant adjustments to capital allocation and pricing, as the low probability of the combined event makes it an outlier that does not warrant substantial strategic changes to current underwriting practices. Option C. Focus on the individual components of the scenario, as historical data for each event exists, and assume that the combined impact will be manageable through existing diversification strategies. Option D. Conduct a sensitivity analysis on each individual risk factor in isolation, and use the average of the potential impacts to inform capital requirements, as a comprehensive stress test for such a unique combination is overly resource-intensive. The correct answer is A. Develop and implement a bespoke stress test scenario that models the combined impact of these events, assess the potential capital depletion, and adjust pricing and capital reserves accordingly to ensure solvency under such extreme conditions. Explanation. This scenario is professionally challenging because it requires the underwriter to move beyond standard risk assessment and consider extreme, albeit low probability, events that could significantly impact the insurer's financial stability. The pressure to maintain competitive pricing and market share can create a conflict with the prudent need for robust capital adequacy and solvency. Strategic underwriting demands a forward-looking perspective that anticipates potential future shocks, not just historical trends. The correct approach involves a comprehensive stress testing program that simulates plausible but severe adverse scenarios. This program should identify key risk drivers, quantify potential losses under these scenarios, and assess the adequacy of capital reserves to absorb such losses. Regulatory frameworks, such as those governing insurance solvency and capital management, mandate that insurers maintain sufficient capital to withstand adverse market conditions and protect policyholders. This approach aligns with the ethical duty to ensure the long-term viability of the insurance business and uphold public trust. Specifically, a robust stress testing framework demonstrates proactive risk management and compliance with solvency requirements designed to prevent insurer insolvency. An incorrect approach would be to dismiss the need for stress testing due to its complexity or the perceived low probability of the identified scenarios. This failure to adequately prepare for extreme events directly contravenes regulatory expectations for prudent risk management and capital adequacy. It also represents an ethical lapse, as it prioritizes short-term profitability or ease of operations over the long-term security of policyholders and the financial system. Another incorrect approach is to rely solely on historical data without considering forward-looking, hypothetical scenarios. While historical data is valuable, it may not capture the full spectrum of potential future risks, especially those driven by unprecedented events or systemic shifts. This narrow focus can lead to an underestimation of potential losses and an inadequate capital buffer, again failing to meet regulatory standards for solvency and potentially jeopardizing the insurer's ability to meet its obligations. The professional decision-making framework for such situations involves a structured risk assessment process that integrates both quantitative and qualitative analysis. Underwriters must actively seek out and analyze potential tail risks, engage with actuarial and risk management teams to develop appropriate stress scenarios, and critically evaluate the results in the context of regulatory requirements and the insurer's risk appetite. The ultimate decision should prioritize the long-term solvency and stability of the insurer, even if it means adjusting pricing or product offerings to reflect the true cost of risk. Question 19. Risk assessment procedures indicate that a potential borrower, a mid-sized manufacturing company, is seeking a significant loan to finance an expansion. While the company has a history of profitability, its cash flow projections for the expansion period show some variability due to anticipated market fluctuations. The underwriter is tasked with negotiating the loan agreement. Which of the following approaches best aligns with strategic underwriting principles and regulatory expectations for prudent lending? Option A. Focus on securing the most aggressive repayment schedule and stringent collateral requirements to protect the lender, even if it places considerable strain on the borrower's projected cash flow. Option B. Negotiate the highest possible interest rate and fees to maximize immediate profitability, assuming the borrower's historical performance suggests they can absorb these costs. Option C. Expedite the loan approval process by relying primarily on the borrower's audited financial statements from the previous year, minimizing further due diligence to meet internal turnaround time targets. Option D. Conduct a detailed analysis of the borrower's expansion plan, market risks, and cash flow projections, and negotiate loan covenants and terms that are commensurate with the identified risks and support the borrower's ability to service the debt, while ensuring adequate lender protection. The correct answer is B. Negotiate the highest possible interest rate and fees to maximize immediate profitability, assuming the borrower's historical performance suggests they can absorb these costs. Explanation. Scenario analysis. This scenario presents a professional challenge because the underwriter must balance the lender's need for a profitable and secure loan with the borrower's desire for favorable terms. The underwriter's role is to identify and mitigate risks, but overly aggressive negotiation can damage the relationship with a potentially valuable client and lead to a suboptimal outcome for both parties. The challenge lies in discerning which loan terms are essential for risk mitigation and which are negotiable without compromising the strategic objectives of the lending institution. Strategic underwriting requires a nuanced understanding of the borrower's business, the market, and the regulatory environment to arrive at mutually beneficial terms. Correct approach analysis. The correct approach involves a structured decision-making framework that prioritizes understanding the borrower's financial health and the specific risks associated with the proposed loan. This approach begins with a thorough review of the borrower's financial statements, cash flow projections, and collateral. It then involves identifying key risk factors and determining the acceptable risk appetite for the institution. Negotiation should focus on aligning loan covenants and terms with these identified risks, ensuring adequate protection for the lender while remaining realistic for the borrower. This aligns with the principles of prudent lending and responsible risk management, which are fundamental to maintaining the stability of the financial system and adhering to regulatory expectations for sound underwriting practices. The focus is on creating a loan agreement that is both commercially viable and compliant with all applicable regulations, ensuring transparency and fairness in the negotiation process. Incorrect approaches analysis, focusing solely on maximizing the lender's immediate profit margin without adequately assessing the borrower's repayment capacity or the underlying risks, is an ethically and regulatorily unsound approach. This can lead to the origination of loans that are likely to default, exposing the lender to significant financial losses and potentially violating regulatory requirements for sound lending practices. Prioritizing speed of execution over thorough due diligence and risk assessment is also problematic. Regulatory frameworks emphasize the importance of a comprehensive underwriting process to prevent the accumulation of bad debt and to protect the integrity of the financial markets. Failing to adequately investigate the borrower's business model or market position can result in overlooking critical risks, leading to a poorly structured loan agreement that may not be sustainable for the borrower or secure for the lender. Professional reasoning. Professionals should employ a decision-making framework that integrates risk assessment, strategic alignment, and ethical considerations. This framework involves 1. Comprehensive due diligence, thoroughly understanding the borrower's financial situation, business operations, and the economic environment. 2. Risk identification and quantification, identifying all potential risks and assessing their impact. 3. Risk mitigation strategy, developing loan terms and covenants that effectively mitigate identified risks. 4. Strategic alignment, ensuring the loan supports the lender's overall business strategy and risk appetite. 5. Fair negotiation, engaging in transparent and ethical discussions with the borrower to reach mutually agreeable terms. 6. Regulatory compliance, ensuring all aspects of the loan agreement comply with relevant laws and guidelines. This systematic approach ensures that decisions are informed, defensible, and aligned with professional standards and regulatory obligations. Question 20. Quality control measures reveal a recurring defect in a key component used in a line of consumer electronics manufactured by a significant policyholder. The manufacturer has acknowledged the issue and is implementing a revised production process, but the full impact on future product reliability and potential claims is uncertain. As the strategic underwriter responsible for this account, which of the following actions best aligns with prudent underwriting practices and regulatory expectations? Option A. Advise the policyholder that the insurer will be withdrawing coverage at the next renewal date due to the increased risk profile. Option B. Immediately increase the policy premium significantly and impose stricter claims handling procedures to offset the potential for increased claims. Option C. Accept the manufacturer's assurances that the issue is minor and will be resolved without further investigation, maintaining the current policy terms. Option D. Request detailed information on the defect, the manufacturer's corrective actions, and their projected impact on future claims, and engage in a dialogue to explore potential risk mitigation strategies or adjustments to the policy terms. The correct answer is B. Immediately increase the policy premium significantly and impose stricter claims handling procedures to offset the potential for increased claims. Explanation. This scenario presents a professional challenge for a strategic underwriter due to the potential for significant financial loss and reputational damage stemming from a product defect. The underwriter must balance the need to maintain profitable business relationships with the imperative to protect the insurer and its policyholders from undue risk. Careful judgment is required to assess the severity of the defect, the manufacturer's response, and the potential for future claims, all within the context of the underwriting agreement and relevant regulatory expectations. The correct approach involves a thorough, data-driven assessment of the defect's impact and the manufacturer's corrective actions, followed by a collaborative discussion with the insured to determine appropriate risk mitigation strategies. This aligns with the principles of prudent underwriting, which mandate that insurers only accept risks they can adequately price and manage. Furthermore, regulatory frameworks for insurance underwriting, such as those governing solvency and fair treatment of customers, implicitly require insurers to act in a manner that prevents excessive or unmanaged risk accumulation. By engaging with the manufacturer and potentially adjusting terms, the underwriter demonstrates due diligence and a commitment to maintaining a sound underwriting portfolio thereby fulfilling their fiduciary duty. An incorrect approach would be to ignore the quality control findings or to take punitive action without a comprehensive understanding of the situation. Ignoring the findings would be a failure of due diligence, potentially exposing the insurer to unforeseen claims and violating the principle of underwriting based on accurate risk assessment. This could lead to regulatory scrutiny for inadequate risk management. Taking punitive action, such as immediate cancellation or drastic premium increases, without a thorough investigation and discussion with the insured, could be seen as unfair treatment and a breach of good faith, potentially violating consumer protection regulations and damaging the insurer's reputation. Another incorrect approach would be to accept the manufacturer's assurances without independent verification. This relies on assumptions rather than evidence, which is contrary to the principles of sound underwriting and could lead to significant financial losses if the assurances prove unfounded. Professionals should approach such situations by first gathering all relevant facts, including the nature and extent of the defect, the manufacturer's proposed solution, and any historical claims data. This should be followed by a structured risk assessment, considering the potential for future claims and the adequacy of existing policy terms. Communication with the insured is paramount, aiming for collaborative resolution that addresses the identified risks while preserving the business relationship where possible. If necessary, this may involve recommending or requiring specific risk control measures, adjusting policy terms, or, as a last resort, considering termination of coverage if the risk becomes uninsurable.